Most investors think crushing the market means finding something early. A new company, a risky bet, a stock no one is talking about yet. But when you actually look at what has beaten the market over decades, the truth is much simpler. The biggest winners are usually dominant businesses that already control massive parts of the economy and keep compounding quietly year after year. That's exactly what we're talking about today. These are two stocks that I believe are positioned to crush the market over the long run. Not because of hype, but because of durability, scale, and the ability to keep growing even as the world changes. And I want to be clear about something. When I say crush the market, I don't mean doubling overnight or making headlines next quarter. I mean consistently outperforming over long stretches of time. 5 years, 10 years, 20 years. That's where real wealth is built. Before we get to the video, if you're new here, my name is Elliot. I make videos about investing, the stock market, and I do updates on my own portfolio, which is on the Robinhood app. If that sounds like something you'd enjoy, consider subscribing. I upload new videos every 2 weeks. Let's start with the first stock, Apple. Apple is one of the most misunderstood stocks in the market. People often say it's too big to outperform, that innovation has peaked, and that growth is slowing. But Apple doesn't need explosive growth to crush the market. What makes Apple so powerful is the ecosystem it has built. This is a company that has embedded itself into people's daily lives. Phones, watches, headphones, tablets, laptops, services, payments, and entertainment. Once someone's inside that ecosystem, switching becomes inconvenient. Messages don't sync the same, devices don't communicate as smoothly, and the experience starts to feel disconnected. That friction creates loyalty, and loyalty creates predictable revenue. Apple also generates an enormous amount of cash every single year. That cash gives the company options. It allows Apple to invest in new products, expand services, improve existing hardware, and most importantly, return capital to shareholders. One of the biggest reasons Apple has crushed the market historically is share buybacks. The company has consistently reduced its share count. That means if you own one share today, you own a larger percentage of the company than you would have years ago. Even during slower growth periods, earnings per share can continue rising because there are fewer shares outstanding. That's quiet compounding happening behind the scenes. Another unappreciated strength is pricing power. Apple's customers are willing to pay a premium. Even during economic uncertainty, people continue upgrading their devices and paying for subscriptions. That kind of resilience matters during market downturns. And something else that matters is brand strength. Apple's brand is one of the most valuable in the world. And when customers trust a brand deeply, they are less sensitive to small price increases, and they are more likely to try new products from the same company. That trust compounds just like earnings do. Apple isn't trying to reinvent itself every year. It improves, enhances, and scales, and that steady approach is exactly why it has rewarded long-term investors so well. Now, let's talk about the second stock, Microsoft. Microsoft is one of the most important companies in the global economy, and in my opinion, one of the safest ways to bet on long-term progress. This is a business that sits at the center of how companies operate. Email, documents, spreadsheets, presentations, communication tools, and operating systems. These products are deeply embedded into everyday work life. Once businesses adapt Microsoft's tools, they rarely leave. Training costs, the data involved, and the way teams work day to day makes switching difficult, which gives Microsoft a durable advantage that competitors struggle to match. Think about that. If an entire company runs on Microsoft software, moving away just isn't downloading a new app. It means retraining employees, moving data, and risking downtime. Most businesses simply won't take on that risk unless they absolutely have to. Beyond software, Microsoft has become a backbone for digital infrastructure. Companies of all sizes rely on Microsoft to store data, run applications, and scale operations globally. As businesses continue shifting operations online and upgrading their system, that demand only grows. Artificial intelligence adds another powerful layer to the story. Instead of forcing users to learn entirely new platforms, Microsoft is embedding AI directly into the tools people already use. That lowers friction and increases usage naturally. What really separates Microsoft from many growth-oriented tech companies is its financial strength. This company produces massive free cash flow. That allows it to invest aggressively in future technologies while still paying a dividend and buying back shares. Microsoft doesn't rely on one product or one trend. It has multiple revenue streams that reinforce each other. Subscriptions, enterprise services, infrastructure, and consumer tools. That diversification provides stability and long-term growth at the same time. Another key advantage is leadership and culture. Over the years, Microsoft has shown that it can adapt to new waves of innovation without losing its core strength. That ability to evolve while protecting its foundation is rare. When markets struggle, companies cut costs, but they rarely cut the core software that keeps their business running. That makes Microsoft incredibly resilient across economic cycles. Now, when you zoom out and look at both of these companies together, something becomes very clear. Apple dominates consumer technology, Microsoft dominates business technology. One owns your pocket, the other owns your workplace. Both have global reach, both have loyal customers, both generate massive amounts of cash, both return capital to shareholders, both adapt slowly and carefully rather than chasing trends. And here's the part that most investors overlook. These types of companies don't need perfect conditions to win. They don't need explosive GDP growth. They don't need hype. They just need time. Time for revenue to grow. Time for buybacks to produce shares. Time for dividends to compound. Time for innovation to layer on top of existing dominance. As investors, our job isn't to predict every twist and turn in the economy. Our job is to identify exceptional businesses and give them time to work. That's how wealth is really built in the market. Not overnight, but through ownership and patience. These aren't stocks designed to make you rich next month. They're designed to compound wealth over decades. They may not beat the market every single year. There will be periods where other stocks outperform. But history shows that owning high-quality businesses with strong balance sheets and durable advantages is one of the most reliable ways to crush the market over time. If you enjoyed this video, make sure to give it a like, subscribe to the channel, and let me know in the comments below. Do you invest in these two stocks, and what are your thoughts on them? And we'll see you next time.